Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research Global Markets EMEA and International Securities. It's Friday, 24th November 2023, and joining Derek to pose some questions on the financial market themes for the week ahead is Shan Husain, Vice President, Institutional Investors FX Sales EMEA. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hello, Derek. Welcome to the podcast. How are you?
Hi, Shan. I'm good. Thanks. I'm good. And you?
Oh, well, thank you. And welcome to our listeners. Let's get cracking. This week saw another week of declines from the US dollar, although the scale of depreciation this week was a lot less than last week. Is the momentum and appetite for selling the dollar set to fade further from here? Or do you think this episode of dollar selling has more to run?
Yeah, thanks, Shan. Yeah, I'm looking at my screen right now, and pretty much the dollar is down against every other G10 currency on the week. So on a DXY basis, it's a little bit more contained because the euro, in fact, is the second worst performing G10 currency this week. So it's only up 0.3% against the dollar. So given its importance in DXY, the DXY move has been relatively contained. Like certainly from a technical perspective, what's happened of late was pretty important, breaking through the 100 and 200 day moving average in euro dollar. And if you take the 50, 100 and 200 day moving averages, the speed in which we broke through all of those three technical levels, the last time it had happened like that was back in April, May of 2020. And essentially euro dollar went from those levels when we broke the moving averages of around 110, and we went all the way up to 121 by early 2021. So it was the beginning of a big move, basically, those technical breaks. So technically, I'm sure that the market's encouraged into the potential for euro to continue going higher. As you said, Shan, the momentum has kind of faded, certainly for euro. The Kiwi dollar is the best performing currency this week, Aussie and pound being the other two in the top three performers on the week. From a risk perspective, global growth, equity markets has helped, I guess, to lift some optimism. So, Kiwi and Aussie, there's some reasoning there for the outperformance. But for euro, we would be cautious about the extent of further gains from here. And certainly, I'm not surprised that it's underperformed relative to the rest of G10 this week. There's been a kind of a number of developments that would at least curtail or temper some of the appetite for euro buying. The ECB minutes, for example, we certainly felt there was signs there of increased confidence about inflation, and they mentioned one of the underlying measures that they look at as being very close to the 2% price stability target. But that, on the other hand, domestically generated inflation was still above 5%. And that, therefore, wages and the labour market would continue to be important going forward. But I would argue that when you look at the wage developments, while the negotiated wages are up nearly 5% on an annual basis, if you look at the Indeed wage tracker, that has been trending down and is now down at 3.8%. So if this does signal, as being a reliable indicator, I think we're at the turning point for wage growth, and that will certainly be consistent with the ECB next year becoming a bit more confident in terms of the scope for rate cuts. There's roughly the same as the Fed in terms of easing for next year, about 70 basis points by October, November time. And if inflation continues to fall in Europe, given the weak growth backdrop, again, confirmed in the PMIs stabilized, so that's, I guess, good, but there's still particularly in Germany, well below the 50 level on the manufacturing side. So it does point to continued economic weakness. I think there's a chance that the markets could actually start to price in the ECB being a bit more aggressive than the Fed, and I think that would certainly kind of diminish the appetite for buying euro up at these levels. So, we've a forecast for around 112 euro dollar by the middle of the year. We had that level set when we were trading 105, 106. Admittedly, we thought we could go lower first before we'd get up to those levels of around 112. At the moment, we're not rushing to change those levels. So in other words, we just think we've seen a big move, and we'd be somewhat cautious about the scale of going considerably higher from here. I think also on top of that, the politics in Europe obviously needs a mention as a potential negative risk going forward. So the Dutch election and the victory for the Freedom Party and Geert Wilders winning 37 seats. Next best party won 25. While it's not a huge surprise that he won, the scale of victory was certainly a surprise. Now, there hasn't been that much negative reaction in relation to this election result, and I think that's partly reflective of the fact that, in terms of Nexit, as it's being called, and while Wilders did and does push the idea of a referendum to leave the euro, opinion polls suggest that that's not why he won the election. He won the election on immigration, and the sheer scale of increase in immigration in the Netherlands has become a big issue. So it's not on euro negativity, and indeed opinion polls in the Netherlands show only around 30% support for leaving the single currency. That's still relatively high, I guess, but it's nowhere near indicative of strong views on leaving the single currency. And of course, he would still need wider support within Parliament to push through a policy of holding a referendum. And I would imagine any coalition agreement that may be reached to give him the premiership, it's very unlikely to include anything in regard to the possibility of a referendum. So the market impact hasn't been significant, and I think for that reason. But in terms of the immigration story, it is a negative in itself, and it does point to the potential for further advances for far-right political parties in Europe who are in general anti-euro. Obviously, the AFD in Germany is now the second most popular party. We've had reports this week in Finland of requirements for additional border security because there's been a surge in immigrants coming into the country over the Russian border. And there's been implications that Russia is assisting in getting these immigrants across the border. So that could become a bigger issue. And then, of course, last night in Ireland, we had quite shocking amount of social unrest, something I've never seen while I've been here in London or when I lived in Ireland. Huge amount of violence prompted in part by increased anger over the scale of immigration, in particular in more recent years, Ukrainians coming into the country, but wider immigration figures, which have been quite significant. So yeah, it's there as something that could become a bigger and bigger issue, and I think medium term risk perhaps, but something to monitor, in particular in the Netherlands after what's happened this week. So that's another reason I think to be a little bit cautious about the scale in which the euro can continue to advance from here.
Yeah, thank you, Derek. And that sort of segues nicely into my next question. Looking ahead to next week, what may be the key events or developments that could drive FX markets?
Yeah, I guess there's no kind of standout event on the calendar. Next Friday is the 1st of December, but the payrolls report will be the following Friday on the 8th. So we don't have the payrolls report next week. We do have the usual end of month data, and I think certainly from a US perspective, the core PCE price index that will be important for the markets, of course, and it should certainly show another decline. That's definitely what the markets are are expecting. And then you've got the ISM, of course, on Friday. So data towards the tail end of the week. But also, Fed Chair Powell is holding a fireside chat on Friday evening at 4 p.m. So that's something to watch as well. But beyond that, obviously, it's Black Friday today. So first thing next week, we'll have some of the high frequency data in terms of consumer spending in the United States. And again, that will probably set the tone for the early part of next week. Outside of that, we've got the RBNZ meeting, and the markets are expecting an unchanged monetary stance there. And I don't think there's going to be any big surprises from that, and I think it's the market pricing is that the RBNZ is done. I would agree with that. I think that's definitely, just looking at the OIS curve, there's about 35 basis points of rate cuts priced by October of next year, so less than what we have elsewhere. So if there was any kind of dovish signs of them being a bit more confident about signaling the possible end of tightening, that could result in more easing being priced into the back end of 2024, which could result in some underperformance of Kiwi, and I guess especially in the context of it being the number one performing currency this week. Other than that, we've had a breakdown in the possible agreement in Taiwan for the opposition parties to run on a joint ticket, which could have raised prospects of the current ruling party being unseated, but that seems less likely now. A victory for the opposition would have been good from a China-Taiwan conflict perspective, easing those risks. So I guess that's a negative development that's happened this week, and we should watch for that at the start of next week to see if there's further fallout from that. So yeah, that's it. No major specific events, I guess.
Thanks, Derek. Finally, probably my most interesting question of the week. You have recently been running short dollar trade ideas in your FX Weekly. Have you any update for our listeners on your trade views or recommendations?
Yeah, we opened up a short dollar yen trade idea last week, and we're still running that. Looked pretty good at the outset of the week, but yeah, remarkably, dollar yen has rebounded from the lows earlier this week, and we're pretty much back to the levels where we were last Friday. So, positioning data shows there's still big short yen positions in the market. There is this, as I said, incredible resilience, even though I would argue that the kind of macro backdrop that drives dollar yen in terms of US rates and the expectations on the Fed, even though the market's becoming more confident that, number one, the Fed is done tightening, and number two, the amount of easing in the back end of 2024 has increased. There is still this appetite for buying dollar yen on dips, and we've had that again. But we're going to keep the position. I just think as we go through in towards the December BOJ meeting, there'll be more on the idea of the BOJ removing its negative rate policy, possibly at the January meeting. I think that's more important for FX perhaps than YCC changes. We've already had a number of YCC changes. So YCC as a policy framework is less important. The 10-year yield can move more freely now. And in that context, I think the negative interest rate policy is more important. And if the markets do get more convinced on that being removed, I think that on top of a slowing US economy and more conviction on Fed rate cuts next year will eventually see dollar yen correct more convincingly to the downside. Our kind of short-term regression model puts fair value at the moment at around 143, somewhere to target.
With that, thank you, Derek, for your insights, and thank you to the listeners. And we wish everyone a great week ahead.
Indeed. Thanks, Shan.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.